Hi there, my name is Jason Ayers, Director of Business Development at Croft Financial Group and a member of the Investment Review Committee. On behalf of the committee, thank you for taking the time to watch our monthly review and commentary for August 2018. One of the most notable headlines for the month of July was the significant sell-off in two of the FANG stocks. FANG is an acronym used to describe the tech stocks which have been leading the market for quite some time. The group includes Facebook, Apple, Amazon, Netflix, and Google. These stocks have been very attractive to investors due to their upside momentum. However, both Facebook and Netflix surprised the market with a less than favorable guidance during their latest earnings report, sparking a momentum factor meltdown. On the Canadian front, financials remain strong while materials, most notably gold, continue to sell off alongside energy. Moving on to fund performance. For the month of July, the Equity Growth Fund finished positive 0.68%, while its benchmark, the TSX Total Return Index, added 1.15%. Year to date, the Equity Growth Fund is up 4.89%, with the TSX Total Return benchmark trailing at 3.12%. Lead manager Alex Brandolini confirms that broad performance within the equity pool was strong for the month of July, except for Facebook and Netflix, citing that Facebook detracted from pool results significantly at the end of the month, leading to a drag in performance. On July 25th, Facebook reported a beat on earnings per share, but a miss on both revenue and average monthly users. Further to that, CEO Mark Zuckerberg provided an outlook for operating margins that disappointed investors. On the back of these disappointing results, Facebook registered the largest one-day drop in market capitalization history. We feel concerns about margin compression are overblown since we believe Mark Zuckerberg and COO Sheryl Sandberg, along with their industry-leading experience, will find ways to monetize content consumption. Further to that, we believe there is a certain amount of conservatism built into the guidance provided by Zuckerberg so he can return to a beat and raise cycle following this revenue miss. Notable actions taken within the equity pool included selling Boyd Group Income Fund as it reached full valuation. This was part of our ongoing strategy of actively managing and locking in profits on our momentum stocks. We purchased a couple of Canadian momentum names with strong fundamentals on a pullback. Strategic option writing also continues to be an active strategy to take advantage of highs and lows on some of the technology stocks on our watch list as prices continue to chop about. Our income fund finished the month of July up 1.20% compared to the real-world index income benchmark, which was down 0.15%. Year-to-date, the fund sits positive at 3.84% compared to its benchmark, which trails at 0.89%. Lead manager Mark McAdam repurchased S&P 500 put options as part of an ongoing hedging strategy. Mark adds that the put option should increase in value as market fear and uncertainty increases and the value of the S&P 500 drops. This will act as a bit of an insurance policy, helping to offset some of the potential downside in the fund should the U.S. market sell off. In addition to the reintroduction of the hedging strategy, we added to our tech sector position during the July sell-off, increasing the overall exposure by 10.3%. Profits were captured in the financial sector, resulting in a reduction of exposure by 11.5%. That said, the overall exposure to equities was reduced and exposure to bonds and cash was increased. The cash raised in July through the reduction in the equity exposure has been earmarked to take advantage of quality companies that experience a sell-off due to short-term temporary issues. Mark notes that the Sharpe ratio of the income fund increased to 1.85 from 1.26 in July and continues to reflect a better long-term Sharpe ratio over its benchmark, as does our equity growth fund. This observation suggests that we are managing risk efficiently. Many investors focus on returns without considering the amount of risk a portfolio manager has taken to achieve their numbers. The Sharpe ratio is a metric which tracks the average return per unit of volatility or total risk. Typically, the higher the Sharpe ratio value, the more attractive the risk-adjusted return. Our option writing fund is designed to drive cash flow using income-generating option strategies regardless of market direction. The fund finished July positive with a 0.49% gain. However, it once again lagged its benchmark, the Montreal Exchange Covered Call Writers Index, which finished the month positive 1.64%. As of the end of July, the option writing fund sits at a 2.13% return for the year, while the Montreal Exchange Covered Call Writers Index currently sits at 3.29%. Lead manager Richard Croft notes that the fund remains balanced between value and momentum stocks and is 77% invested, with 23% in cash held for new opportunities and cash equivalents. As mentioned last month, the average duration of time until expiration for the option rights remains on the shorter side at 33 days. Richard adds that shorter-term options are being written more specifically on the momentum stocks, where the option premiums tend to be more attractive due to the increased short-term volatility. With many of the value positions paying dividends, longer-dated options typically results in longer holding times and the collection of the dividends. While Facebook and Netflix acted as a bit of a drag on performance for July, positions in Apple, Amazon, and Google balanced out the impact with their positive performance. Looking forward, we feel July's sell-off in the tech sector was a positive signal for the health of the overall market, as momentum stocks typically underperform in the first month after a market correction, such as the one we saw in February, followed by strength and overvaluation in the subsequent months. Momentum taking a breather historically has been consistent with the development of a broader bullish trend. Evidence of this comes from current year and fiscal 2019 market expectations. Despite Netflix and Facebook disappointing, better than expected results in most reporting companies has caused analysts to revise their earnings and sales forecasts upward. This indicates that companies are still growing and makes investing in stocks an attractive opportunity. Looking out further, one thing we are monitoring are operating margins. In both 2011 and 2015, peaks in margin estimates accurately predicted market tops. Given the capital expenditure cycle that is underway and the potential for trade risks to slow down revenue, margins are something we continue to watch very closely. Finally, strength in the US dollar will continue to weigh heavy on gold and oil, which will act as an anchor for the broader Canadian economy. As always, we will continue to evaluate and adjust as market conditions change.